Sorry guys, my power just went off. Sorry for that.
Sorry.
Okay, yes, this is what we were discussing. Okay, now you can have cases we are saying that at Force 2, okay, definitely. It means that they do have 18 years to go before they make the payment, which means therefore, if you have to make the payment to this scheme, okay, of course, in quotes, okay, you will be, it's like a nuisance, okay, let me use that term, it's like a nuisance to the scheme because they don't want the money in quotes, okay, well, they have 80, the time, don't forget, their main expenditure is the payment they do make to the contributors. But how many years do they have? The need is going to arise 18 years from now. So you pay them money, if anything, is going to be a distraction to them because if you pay them a dividend, they have to look for another investment to invest their money that matures in 18 years' time. Okay, which means that for them, they don't want the dividend in quote. Okay, because their need is going to arise. Their intended cash outflows are going to be arising in 18 years' time. So for them, for most retirement schemes, okay, they don't want to pay the dividend. Okay, it's worth enough for you as the managers of the company to know what type of shareholder do you have. Do you have individuals? Do you have more of institutions? Okay, corporates. What are our main investors? Okay, if they're more individuals, then of course you may be forced in court. Okay, you may want to pay them the dividend because they do consider the dividend as a supplementary income. Okay, in case, however, you do have most of the investors as institutions, okay, and retirement schemes, benefit schemes, then you may not want to pay them the dividend. Okay, for them, they don't want, in quote, the dividend. Okay, clear on that, Collins?
Yes.
Okay, Anita is clear.
Yes.
Okay, so what was on the dividend decision? Okay, we shall discuss, of course, all of these decisions in detail later on. And as I mentioned, see the connection between all these decisions. That in case, for example, you do make a good decision in terms of investment, you choose a very good investment. That means, therefore, okay, you have to for finance. That I think that we mentioned. So, since this investment you have chosen is a good investment, okay, what does that mean? It means, therefore, that it is going to make more money for the business, which means, therefore, you can be able to pay more dividend to the shareholders. Okay, if you had a good investment, okay, however, you are not able to obtain the finance, that's affect also the dividend. The investment was good, but there was no money. Therefore, what does that mean? It means you can't pay the dividend. Okay, so it's good enough you see all the connection. If you also pay high dividend today, okay, this year you pay out of dividend. Next year, you never know how things should be like. Okay, you may not be able to get money in next year. So in case you do pay high dividends in the current period, in future you may not have enough capital. And don't forget the use of retained earnings is one of the key finance source. Okay, which means therefore, if you pay high dividend today, next year you don't have finances. Therefore, you can't pay the dividend, and you can't make the investment. And since you can't make the investment, there's no money to pay the dividend. Okay, you can see that the three decisions they do revolve around each other. Okay, and by the way, that was a question that examiner asked you. Okay, sometime in the past. Try to discuss. Okay, discuss the three decisions. Okay, and how they do affect each other. The finance decision, the investment decision, and the dividend decision. Okay, Sanya, you can answer that question.
How each of the decisions affect?
Yes, how each of the three decisions relate to each other. Okay, first, of course, to explain the decision and how they do relate with each other. You can answer that.
Okay, so like okay, I'm trying to put this in words. So the finance and the investment, like the finance decision is how about how you decide to get finance into the business, right?
Yes.
Yeah, and then now for that, like that's it depends. Okay, I don't know how to put this in words, but like I get the concept of it. But they're all like decisions that you need to make in order to get a business into the firm. So like you need to see how each decision is going to affect the business.
Business.
Yeah.
I agree, but for 8 marks.
Oh, a lot.
Let
But
me.
if I read it and if I like I just need to read it more so that I can get those 8 marks. But I have a rough idea.
A rough idea of it. Okay.
Yeah.
Let me actually project that question. I'm going through the question bank. I'm trying to search for the question. It's too many. Financing decision. Trying to financing decision. This way I can be able to get the question. It's not there. And let me just manually check the what I wanted to view. Navigation pen. Yeah, that's better. Okay, so I'm going to the question. Let me actually replace that question. If I remember, it was an 8 marks question. Okay, you're being asked to discuss the financing decision, the investment decision, the dividend decision, and of course how they do relate with each other. Okay, so I'm going through the question back right now. So we can get it. You cannot access the e-learning, isn't it? Collins, you can?
Yes, I can.
Okay. Good. Because whatever I have here is exactly the same question bank that I have uploaded on the e-learning. So I can get that question because it. If you see it, so you have to be okay. I suppose that you're also going through the question bank yourself also. So they're simply asking us to discuss the three decisions: financing, investment, and the dividend, and how the two do relate with each other. Yeah, it is actually. Okay, so in my question bank here, it's in page 21. Page 21. Okay, page 21. A company called QSQ. Okay, a company called QSQ company. QSQ company, part C. Okay. Okay, it's asking, discuss the issue between investment decision, financing decisions, and finance decision in the context of financial management. It has been discussion with example where appropriate. Okay, so simply discussing how does the three decisions relate with each other: investment, dividend, and financing. Okay, as mentioned. Okay, just repeat. Okay, this is an 8 marks question. That means therefore more discussion for sure. Okay. You can't have 2 lines for 8 marks, okay? They need to be a thorough discussion, okay? So anyway, to begin with, of course, you define, okay, what we mean by what is investment decision, Let me repeat, investment decision is simply about appraising the different company, long-term investment the company be having. Okay, capital project is the appraisal. Okay, trying to know where should the company be investing its money in. Okay, which project. Okay, how much value do we get as a company if we are to choose this particular investment. Okay, and of course, definitely, as mentioned, the key step when it comes to the investment decision is the financial analysis bit of it, quantifying the cash inflow, quantifying the cash outflows, okay, that the company will be incurring, okay, and of course, appraising them using the different methods, okay, which I think we shall discuss it alone, okay. The NPV, for example, the net present value method, the return on capital employed, okay. So that is going better, the investment decision, okay. Financing is where are we going to be? This investment is going to cost us 10 million. The next question is that how are we going to be raising money, okay, to finance this need we have, to finance this capital project we have, okay. So it's about getting to know the source of capital, for example, okay, getting to know the source of capital, for example. The next thing, the finance decision, is of course you quantify, okay, how much cost are we going to be incurring as a business if you are to use this particular financials, okay, as well as checking, okay, whether this finance decision, okay, the use of debt, the use of equity is going to help us achieve our optimal capital structure, for example. The dividend decision is about how do we distribute, okay, the capital among the different, how do we distribute the earnings of the company to the shareholder, okay. The earnings, any distribution made by the company to the shareholder is referred to as a dividend. So in this particular topic, you have to make a decision regarding how the company will be distributing, okay, the capital, distributing the earnings to the shareholder. How much dividend do we pay? Okay, when do we pay the dividend? Okay, why do we pay the dividend? Okay, so all that will be under the dividend decision. The interconnection between the dividend decision, as I mentioned, if as a company, okay, you don't make investment, okay. Let's begin, for example, you want to make a project investment, you want to make an investment, okay. However, there's no money, there's no finance. That means, therefore, you can't make the investment because there's no finance. What means, therefore, since there's no finance, you never made the investment, there's no profit you'll be making, there's no dividend, therefore, you can be able to pay. Okay? That's on the finance if there's restriction. If the company, okay, may be having money, however, the company does not have ideas on where to invest its money in, okay, well, that's going to happen where the company don't have ideas where to invest money. So in case you have the finances, however, the company has no ideas where to invest money, that means therefore there's no profit, there's no dividend. At the same time, if as a company, you pay high dividends today, as a company, you do pay high dividends today, that means therefore you reduce or you restrict the amount of retained earning available. Retained earnings is a source of finance. So if you pay high dividends, it means you restrict the amount available for the amount of retained earning available. Now, what does that mean? It means that in the future, your finance capital sources is restricted, is reduced, which means therefore you can't pay the dividend because you never made the investment, so you can't pay the dividend. Is that clear? Sanya from Yango.
So can you explain that part again?
Which part?
Dividend.
Okay, on the dividend. If you do pay high dividends, okay, if you do pay high dividends today, now what does that mean? It means that in future, you'll not be having retained earnings. Okay, for example, you make 10 million of profit, and everything is paid in terms of profit. You pay to the shareholder in the form of the dividend. Now, what remains therefore in your coffers as a company? What remains therefore in your savings? Okay, let's call the savings. Okay, from what we know, it means you have no savings. Okay, it means you have no retained earnings. Okay, that means therefore, if in future, okay, there'll be an investment that is going to be arising, you don't want to invest your money in there. You go back to determine, do we have the money? If you don't have retained earning, then of course that restricts the amount of funds available to you as a business. Which means therefore you can't finance the investment. So since you can't invest the money, it means you can't make profit because the investment was never made. Which means therefore going forward you can't pay the dividends. Clear?
Yeah, okay, I get it. So it basically means that you have to limit the amount of dividend you pay the shareholder. Like you can't just pay everything you earn.
Yes, that's the thing. You can't pay everything that you earn to the shareholder unless I don't know which company. The company that pays
Yeah.
you. I don't know whether the company that do that, but you can't pay. You can't earn 10 million.
Yeah.
You pay 10 million. It is not. It is not prudent for the
Yeah.
company.
Yeah.
Yes, that's what it means. Because in future,
Yeah. True.
that restricts the amount of funds you'll be having, which means you can't invest the money, which means you can't make earnings.
Yeah. Okay. Okay. I
Okay.
get it. Thank you.
Okay. Collins, it was clear.
Yes, sir, that was clear.
Okay. That's great. So those are the three financing. Those are the three core financial decisions. Okay, no, three core financial management decisions. And I think there's a time your examiner asked you in an objective test question. Okay, which among the following is not? Let me see if I can get it. It was a section A question. Okay. Let me see if I can get it. As I told you, most of them are not. More this type of questions they'll be asked in section A. Most of the time they'll be asked in section A of your. So let me go through. Is one of the paper here that has section A. So you can go to get it. So don't ignore this introduction bit of it because sometimes you may be tempted to ignore it and you find it in the exam. Okay, so don't ignore it. So this is an exam in the past. Is a section A type of that was asked for that sitting. Okay, so let me see if I can get a question on those decisions. Yes. Question 11. Is this asking about the scope of financial management? Okay, question 11. Okay, Anita, what do you think is the answer?
D.
D. Yes, the answer is D.
Yes.
Thank you. The answer is D. Okay, because don't forget the remuneration committee. When it comes to the next point about the remuneration committee, that's not part of financial decision. I think that's part of more of corporate governance. Okay, it's more of corporate governance. Okay. Payment of dividends, that's of course we have mentioned. Fundraising and sale of the company assets. Okay, innovation and disposal is part of the capital budgeting decision. Okay, their investment decision bit of it. Okay, Collins, that was clear.
Yes, that was clear.
Okay, Sanya, it was clear.
Yes, sir.
Okay, Brian, clear.
Yes, yes.
Okay, I look for another question which I think you can answer based on what you've just done. Okay, I think the others we can do for now. Let me look for another question for section A type of question. Let's see. That one. That one. That one. That one. Okay, that's that one. Okay, I think that is it for now. If there's another question you can do. MCQ. Okay, let's see if I can get. Okay, that's working capital, not when you have not done. Let's see. Refine this working capital. There's on release. Yes. Question 10. If you're using your question mark, it should be page 76. Page 76, question 10. Collins?
I'd go for D.
Okay, deciding to pay off for staff. Okay.
Yeah.
Sanya? Okay, thank you, Collins. Sanya, what do you think?
I think C.
You think C, advising on investment in non-current assets. Yes, as I see. Don't forget, this is C is a capital. What we have just said. This is part and parcel of the investment decision. This is part of investment decision. Who decides on the pay to the staff? Brian?
Sorry, pay rates for staff.
Human resources. Okay, that is HR. That's HR function, isn't it?
Yeah.
Preparing a main account, that is managing accountant. Okay, financial accountant, that's FR. Okay, so don't forget the only bit we have here is advising on investment in non-current assets. This is about the investment, capital assets, non-current asset, long-term assets. This is therefore is the answer there. Okay, so Collins, you get it. So the decision to pay on how much to pay, okay, is not part of the financial management. Okay, that's part of the human resource department. Okay, to make those decisions as to how much of the salaries to be paid to the employees. Okay, that's is part. You can give advice, but that's not part of the financial management. Okay, clear, Collins?
Yes, sir.
Okay, great. I think that is it. You can be able to answer for now. The others, I don't think. The others we don't have not done. Okay, so that was very simple introduction. You can see the question can also be tested from that particular area. And as I mentioned, more often than not, there will be in section A, more often than not, there'll be a section A type of question. Okay. Sanya, we can take a break.
Sorry, we can take a break.
I'm just asking for all of you. What do you think? Should we take or not take a break?
Maybe we can continue and then finish early.
Okay, that's what are the other things. Okay, fair enough. I guess I'll have no problem then. Okay, fair enough. Okay, let's continue then. The others are okay with that then? Okay, great. Okay, so let's continue. Okay. Then here, the other bit we're meant to discuss is comparing what is financial accounting, and that one, I will not do it for now. Okay. Don't forget, by the way, just before I leave, don't forget, as I mentioned, the prerequisite towards this course is the financial reporting course, which I think you've already done, and the performance management and the management accounting. Okay, but it doesn't mean that in case you've not done it, you should find it in hard parts. No. Okay. Anyway, for the company to be able to achieve, as I mentioned, if you have financial management, as we mentioned, okay, is that we do have is the management of the company capital, the management of the company financial resources in order to achieve financial objectives, in order to achieve some certain objectives, okay? Now, what are the objectives? The objective is the intention. What does the company want to achieve, okay? In the next 2 years, the next 3 years, the next 4 years, what does the company want to achieve, okay? That is what we refer to as the objectives, okay, of a firm. And the objective of a firm, what we call as the corporate objectives, okay? As you shall see, we shall divide them into two. We have called the financial objectives, and the non-financial objective, financial and the non-financial objectives, okay? Now, the means you're going to employ, okay, in order to achieve those corporate objectives, okay, the means, the tactics, the techniques, okay, whatever terms you can use, okay, that you're going to be using as a business in order to achieve those objectives, it will refer to as the corporate strategy, okay, referred to as the corporate strategy, okay, the action plan, okay, what you're going to do in order to achieve that particular objective. So it is what we refer to as a corporate strategy, okay, corporate strategy. And the objective, as I mentioned, okay, they're going to be two, okay, both financial and non-financial objectives. And the objective can be many, okay. For example, increase profit, okay, growth in the market share, to improve the company's, to provide good quality products to the customer, to increase customer satisfaction, to improve company cash flow. There are so many objectives that that as a company you may want to pursue, okay. So we go ahead and split them into main categories, okay? The financial objectives and the non-financial objectives, okay? So the objective, as mentioned, we can further classify the corporate objectives into financial and non-financial objectives. What's the difference between financial and non-financial? It's simply, how do we evaluate whether the objective has been achieved, okay? When it comes to the point of evaluation, when it comes to the point of analyzing whether the objective has been achieved or not, what basis do you use? What measure do we use? Do you use a financial measure or do you use a non-financial measure? Okay. So because in case you use a financial measure, okay, then generally that means therefore that was a financial objective that we are pursuing. Okay. If at the end of the day you're going to use, what measure are you going to use? So in case you use a financial metric to assess whether the objective was achieved or not, then that was a financial objective you were pursuing. If you do use a non-financial measure, okay, to evaluate whether the objective has been achieved or not, then that's referred to as a non-financial objective. You are pursuing a non-financial objective. Okay, clear on the difference? Because it can be confusing. You're going to be given a list of objectives, and again, determine among these one which is a financial objective. Okay, they can be quite confusing. But just get to know that in case it's a financial objective, then you have to look at the end. How do we evaluate how this objective has been achieved? If you're going to be using a financial measure, by financial means money. If you're going to be using a financial measure, okay, then that was a financial objective. Okay, clear the difference? I'll give you an example, and I know it will confuse you. Okay, but don't forget, when it comes to evaluation, whether which objective is financial, which is non-financial, simply try to look at the end. Okay, at the end of this objective, how do we assess whether it has been achieved or not? Do you use a financial or non-financial measure? Okay. Now, when it comes to the financial objectives, there are three. Okay, so here I've mentioned written two, but there are three. Okay, there are three financial objectives you can pursue. Okay, one is to maximize profit, maximize shareholders' wealth, and earnings per share growth. Okay, so there are three key financial objectives which we shall discuss each one on its own. Okay, so to improve the company profit, okay, increase or maximize the company profit, increase the wealth of shareholder, and earnings per share growth. Another financial objectives, we have gearing targets. For example, gearing means like debt to equity. You want to achieve a given ratio. How much of debt do you want to have? How much of equity do you want to have? Okay, when it comes to financing of the company assets. Okay, profit retention is when it comes to paying the dividend. Okay, for every $1 of earnings that we make, okay, how much do you pay as dividend? If you pay, for example, 0.2, it means therefore you have a payout of 20% and a retention of 80%. Okay, because you paid 20, you retain 80. Okay. Then we have called the return on capital employed as another financial target, financial objectives that a company can pursue. Okay. So let's begin with the first objective, the profit maximization objective. Okay, to maximize the profit. Okay, and don't forget this is accounting profit. Okay. Now, first is to get to know how do we determine the profit. Okay, I know you've done this already. Okay, we must say the profit is equal to revenues minus expenses. Okay, revenues minus expenses. Okay, that's how you determine the profit. Okay, it's revenue of the company minus the expenses the company has incurred in earning that revenue. Okay. Now, which means therefore, if as a company you want to maximize the profit, then you can achieve that by increasing the revenue and decreasing the expenses. Okay, increase revenue and you decrease expenses, okay? Or you can do this, okay? Or you can try to see if maybe the revenue base you're going to be earning is constant, is not going to increase. Then you can try to see, let me just reduce my expenses. Let me try to use strategies that will ensure I reduce my expenses, okay? Since my revenue base, to be improving, okay? Or in case maybe it's quite hard for you, or most of your costs are fixed costs, okay? If most of your costs are fixed costs, then try to see on the way of trying to improve your revenue base, okay? Because you may not maximize your profit through decrease in expense, because most of your costs are fixed costs. They're trying to see how can I be able to increase my revenue base, okay? So of course they do vary from business to business, but try to see on ways and mechanisms you can be able to improve the company's profits, okay? That is how you can maximize the profit, okay? Trying to see, okay, should I increase the range of product I'm offering, okay? Should I, what are the different mechanisms, techniques I can use in order to manage my expenses, okay? So all these are ways of trying to maximize the profit, okay? However, we must say that this objective, okay, has its own key limit. It has a number of limitations, okay? It has a number of limitations, okay? First of all, this you're using accounting profit, and I guess you are accountants, okay? Or you have been going through accounting, okay, in the past, okay? And some of these decisions are management decisions, okay? For example, provisions of bad and doubtful debt. Who make the decision as to whether you give 5% or 2%? It is the management to make that decision, okay? Which means, therefore, since there may be some profit angle, some expense angle will be dependent on the management, then that can be an issue for sure, okay? Because if management would want to artificially, okay, boost the profit, they may decrease expenses that are within their within their decisions. Okay, for example, they can decrease the amount of provision they make to reduce expenses. When it comes to the depreciation, who decide on the policy to use? The management. Who decide that this asset will have a useful life of 10 years and not 20 years? Is the management. So in case they want to increase the profit, they may want to increase the useful life of the asset. And of course, don't forget, in case you increase the asset useful life, then of course the depreciation expense is going to decrease. Okay. Therefore, if the expenses are decreasing, the profit is increasing. So you can have a case where the management artificially attempts to boost the profit. Okay, an artificial boost of the profit of the company. Okay. So you mean therefore, this objective has a number of limitations. That being one of them. Okay, it can be artificially be manipulated by the management. Okay, it is subject to manipulation by the management. Okay, another number of things is a sort of goal. Let me ask a question, Brian. Generally, after how long do we evaluate? Okay, what's the maximum period of profit evaluation? Let me use that term. Generally,
Max 12 months.
12 months. Okay, generally we use 12 months. Okay, but for the shareholder, they want to see the company going concern. So we want to go beyond the 1 year. Okay, beyond the 12 months. But for this objective, it restricts itself to the 12-month period. Okay, that's kind of another limitation. We say that this goal is too short term for the shareholder who are there for the long term purposes. Okay. Then, this particular goal is very vague, it's unclear, it's ambiguous, okay? It was a term that can be used, okay? It's a very vague goal to achieve. What do you mean by that, okay? Now, when it comes to evaluating the company profit, you can evaluate company profit using very many different bases. How can you evaluate the company profit? Anita? What are the different ways, okay, of evaluating the company profit? The use of, or what margins? Let me use that. What profit margins do you know?
Net profit margin.
You can use the net profit, okay? You can use net profit. What else?
Return on capital employed.
Return on capital employed. Okay, you can use it, sure.
Let me think about the rest.
Okay. Collins,
Gross profit margin.
you can use gross profit, sure. What else can you use? Operating profit, isn't it?
Yeah.
Operating profit, okay. You can use the profit before into tax, profit after tax, net income, okay, of course, net profit. So there's so many bases, okay, that can be used when it comes to evaluation of profit. But this goal doesn't give us what is the best basis upon which the company can use when it comes to evaluation of its profit. All these are going to give you different figures altogether, all of them, okay? But what therefore is going to be the best basis of trying to evaluate, okay, the company profit. The goal doesn't tell which one is great for us, okay? It does give a particular decision, okay, as to which one of the different bases, for example, we should use when it comes to the evaluation of the company profitability, okay? The other thing we consider that in finance, okay, definitely time value of money has to come in. That means, therefore, if, for example, you're going to take a look at the back the past, okay, you know, maybe 5 years ago, or even tell it like 10 years ago, okay, how much, okay, like for example, okay, let's say about like 50 shillings, okay, how much could it have been able to, what was its power in terms of purchasing, okay, how many items could you buy? Then do the same analysis today, okay? This was, for example, year 2010, year 2020, the same 50 bob, okay? The 50 shilling, okay? How much can it be able to buy for you, okay? What do you think, Sanya? Does it buy more or does it buy less items? Sanya? Okay, you know, I not had an issue. Brian?
Sorry, just repeat.
Okay, if you take an example, okay, you can look for many ago, but I'll just only give an example of what was the power that the 50 Kenyan shilling had 10 years ago, and the power of the same 50 shillings today. Does it buy you more item or less items?
Less items.
It buys for you less item. Why is that the case? Also called the time value. Or one key factor, of course, is the inflation. That generally money has higher value if received earlier than later. Okay, we shall discuss this a lot, but I think actually you've already discussed in some other units maybe. Okay, but generally, that money has higher value when received earlier than later. Now, when it comes to this objective, okay, we don't make any consideration. We assume that everything, the profit earned this year, next year, 10 years from now, is the same profit, which is not the case. Okay, that the value to the money to be received today, okay, will have a higher value than to be received 10 years from now. But we don't incorporate when it comes to the decision, it does not do that incorporation. Okay, which of course is not the best thing. Okay. Then it only consider, it ignores welfare of other stakeholders. So the question is, which among the different stakeholders, okay, suppliers, employees, shareholders, government, management, among all those different stakeholders, who does it consider, therefore? Collins, who does it consider?
Sorry?
You're trying to discuss this second last point here, okay? It ignores the welfare of other stakeholders, okay? So the question was, who does it therefore consider? If it ignores the welfare of other stakeholder, who does it consider?
Employees.
Mm-hmm. Let me give an example. When bank want to reduce cost, what do they normally do? I think you've seen this in most, it happens quite often than not. I think it happens most towards the bank. I don't know, I'm not sure why it happens more towards the bank.
They lay off staff.
They lay off staff. That's the thing. They do lay off of staff members. Now, does it mean that it considers the interest of the employees? It does not consider the interest of the employee. If anything, they are the least considered. If the company was to be a very capitalistic company, they consider profit and profit only and nothing else. So they don't consider the interest of the employees. If anything, you're going to lay you off so that we minimize our expenses. So who does it consider? Brian?
I'd say only the shareholders and
Yes.
maybe the directors if it's a profit-based scheme or something.
Maybe, yeah, true. Okay, it only considers the shareholders because the profit belongs to who. So the question is that the profit which we are trying to pursue, who does it belong to? It belongs to the shareholders. Okay, it belongs to the shareholder, not the employees of the company. Okay, and as maybe the Brian is centered as that if the share management have performance-based contract paid based on their profits, they do get some stake of it. Okay, but generally it considers only the shareholders. So all the other stakeholders, the employees, for example, actually employees are the one who are going to be suffering. Okay, the customer. Okay, we have seen companies that do provide very dubious products. Okay, why do they do that? Because they want to minimize the cost in producing the item. Okay, so it means that for the customers are not considered at all. Okay. If you have monopoly, what do? They increase, of course, the selling price. Okay, in case your case where the company has too much controlling interest in the market. Okay, so therefore the other stakeholders they are ignored, and the only person will be the only person in quote that is being considered is the shareholder. Okay, Collins is clear.
Yes, sir, it's clear.
Okay. Then the other thing is it ignores risk and uncertainty. And here the key risk, which I think I already mentioned, is the inflation. Let me give an example when it comes to the inflation side, in case that it can be clear maybe. Let me share. Assume that we have a case here of a company, the target. So the company shareholders of the company in the year 2020, beginning of the year 2020, okay, they give a target to the manager that hey, we need to have our revenue, okay, at let's say value of let's say 10 million. The expenses at that point in time need to be 5 million. That means for the profit of the company, the target profit is equal to 5 million. Okay, it seems to be a very bad target to achieve. Assume we have an inflation that do occur in that year. There's inflation that occur. But such that the increase, such that the inflation, or don't forget, inflation is the increase in the price of commodities in the market, in the economy. Okay. Assume that the company experiences, okay. Let me get an example actually. Let me assume that these are the target. These were the value for 2019. This was the company achieved. The target for the company in year 2020 is a profit of, let's say twice. Okay, let's test twice. Okay, let's 7.5 million. So the shareholder give a target to the management that the profit we want you to achieve in the year 2020 is 7.5. Assume that in the year 2020 there was an inflation experience of 100%. And of course, there's some countries where the inflation is quite more than this, okay? But let's assume it's 100%, which is very high for sure, okay? Now, therefore, what becomes of the revenue? Assume that the management have done nothing, okay? They remain where they were. What becomes of the company revenue in the year 2020? Sanya, are you back, Sanya? Not sure if it's Sanya. Anyway. So Anita, what do you think could be the revenue for the company in the year 2020? You got the scenario, Anita?
Yes.
You got the scenario?
Yes, but I'm not sure how to answer the question.
Don't worry, in case, just give us the answer. Don't worry if it's correct or not.
I think the revenue would be less.
Sorry, I didn't hear you well.
I think the revenue would increase, but the expenses would increase much more.
Okay, so the question is, what will be therefore be the revenue for the year 2020? Don't worry about the expense for now. The revenue for year 2020. Last year, it was 10 million. This year, there has been an inflation that has hit the country of 100%. Assuming that the status quo remain, whatever you produced last year is what you produced this year. What becomes of the revenue?
20 million.
20 million, yes. The revenue will be 20 million, okay, 20 million. The price of commodity have doubled, in short. There will be 20 million, okay. Brian, what happens to the expense?
The expenses double as well.
The same, the expense will double as well. To give us therefore profit of equal 10, 20 minus 10 to give us 10 million. To give us therefore 10 million. Therefore, the question is, okay, we want to make an evaluation of our managers at the end of the year. Have our managers been able to achieve what we agreed upon? So, Collins, have they done that? Have they achieved the target?
I'm not sure, sir.
Okay, Brian, what do you think?
Okay, the initial arrangement was for profits to be 7.5.
Yes, to increase to 7.5, true.
Then 7.5 doubled would be 15. I don't think they've achieved it.
You don't think they've achieved them? They've achieved the target?
Yes, because we should factor inflation for the profit as well.
I agree. They ought to have factored the inflation, but when it comes to evaluation, if you go through single analysis, if you go through the profit and loss account for any company, even the one normally published on the newspaper, do they say that the inflation after the profit after inflation is equal to X amount?
No, they don't.
They don't. The inflation bit is ignored. For example, in this case, the company's profit, the target was 7.5. And they have achieved 10 million. So we can say they did achieve the target, even though we know in reality that they did not achieve that target. They did not achieve that particular target because here, there's nothing the manager have done. If anything, if we are to factor in inflation, we go back to where we were at 5 million. But they don't factor, this objective doesn't factor in, therefore, that risk of the element of risk and uncertainty, one of them being on the inflation. Don't forget here, to make it worse, okay, you can even add up, since the target was 7.5 million, if you are to pay your managers based on them achieving the target, this year you pay them at a premium, you pay them a bonus, whereas they have done nothing. Because their 10 million is higher than 7.5. So you end up paying them a bonus, whereas they don't deserve a bonus. It's simply because there was inflation in the environment for that particular time period. Okay, so all these are limitations. Yes, sure. That's Collins.
No, I have a question.
Yeah, sure.
So in this example, the 10 million is the accounting profit.
Is there?
Accounting profit.
Yeah, this is accounting profit, yes. This is accounting profit. And actually using this objective, we are based it on accounting profit. We are based it on accounting
profit.
Yes.
Okay, thanks.
Okay. Therefore, that's why you see that it's not a very good goal, okay, for the company. It's a goal you can pursue, but it should not be the only goal you're pursuing, okay, as a business, okay. There are other better objectives that you can pursue as a business. There are other better objectives, okay, and that's why the next objective, or the shareholders' wealth maximization objective, okay, comes in, okay, to try to do away, if anything, to try to see can some of those limitations we have identified be done away with. Okay, so then we have the shareholders, wealth, maximization objective. Okay, comes in. But before we discuss that as next objective, okay, I would want us there's a question like I saw from the past paper, okay, yes, the question like I saw that was asking you to go through to another among the choices, which one is the limitations, which one is a limitation, which one is not a limitation. Try to, it was a what type? It was type section A type of question, if I remember. I can see it. Let me see. If you get it, let me know. Is that section A type of question? So asking you among the following limitations, which one is not a limitation of profit objective? I remember that's how it goes. It's not there.
Would it be page 54, number 12?
Yes, it is here. Thank you. Yes. Page 54, 52. Okay, for my case.
Sorry. 52.
Mine is 52, but it can be 54. But page 12, okay, is 52, 50. It's page 54. Okay, for my case here, it's in page 52. It can be 54 in your question mark there. Okay, so go through it, then you give me the answer. Of course, I know you have an answer already.
Sorry, 54.
I'm not sure which exact, but for my case, it's in page 52. Question 12. You've seen it?
Yes, thank you.
Okay, great. Collins, what do you think is the answer? Actually,
1 and 3.
here there's a typo here. You can see, I don't know, for my case, there's a typo. This should be A, this should be B, this should be C, and this should be D. Okay, it's a simple small typo there. Okay, so should be, which answer?
A, 1 and 3.
1 and 3, which of the following statement are correct? Okay, economic profit is not the same as economic profit, true. Economic profit can be multiplied by managers, very true. And 2, profit takes account, it does not take account of risk. Yes, I agree. It's 1 and 3. So that should be A. Yes. Okay. Question. Okay, there seems to be another question. Then great, that's also on profit maximization objective. Okay. Then I guess tomorrow then we can start off and we start discussing on the shareholders' wealth maximization objective. Okay, we proceed from there. Okay, guess we can end the class here. We meet tomorrow. Okay, that is in case it's no other question. Okay, fair enough. Then we can meet tomorrow at, I'm not sure what time, but I think we just follow the